Good afternoon, ladies and gentlemen, and welcome one and all to an action-packed week ahead with the UTC. Now, today's video is going to be all about the market report. Not necessarily too much about the report, but what's in it, the important stuff. Now, this week is going to be very, very volatile, or so we hope. Volatility is a trader's friend, not a trader's enemy, like many would lead you to believe, because with volatility comes movement, and we like movement. Now, this week we are looking at a whole array of different economic indicators. We've got the BOC on Wednesday or Thursday, I believe. We've got the ECB's interest rate decision as well. And we've got a full rack of US employment data. It is that special time, the first Friday of the month, where we have the non-farm payrolls. So we have plenty of reasons to get stuck into the markets and hopefully take a few positions. And even more so, make them a few wins. So we're going to break it down. We're going to have a look at the market report, see what's occurring. So first of all, on the first page of the market report, for those of you who do not subscribe for some random reason, it's all about our UTCF, which is the Underground Trading Group's fund. And the fund was started almost 3 years ago, and it's been done live in front of our members every single day of every single week since its inception, which is incredible. Now, our total cumulative returns, excluding withdrawals, has been over 1,000%. It's been one hell of a journey. It's been really good. But anyway, last week was a really great week in the markets. We actually ended up doing 7.4% realized net growth, which was, safe to say, a pretty damn good week. I mean, before that, May was looking pretty rocky. The first half of May, we had tariff war, and that was followed up with tariff apologies. We had market sell-offs, we had market recoveries. It was a turbulent time throughout the month of May, and we managed to we managed to sustain ourselves. And we had to run a bit of a diversified risk strategy. We had to draw things back in a little bit, just be a little bit tentative to the situation. And then the last week of May, I don't know what happened, but we just blew the lid off it and did a 7.4% return across our three major asset classes here, the FX, indices, and commodity space. It was freaking great. So indices, we did 62%, which is whopping market exposure. We had Forex taking 33% of our total exposure throughout the week, and then we had commodities as well. Commodities breaking in 5%. We actually did a really nice position in US crude, maybe even two really nice positions in US crude. I can't remember right now, but we did one really amazing long. It was a 1-to-3 return, beautiful trade. And that really helped prop the fund's returns up over the week. And so looking down and breaking it down day by day, we had a minus 0.25% drawdown day on the Monday. So it didn't get off to the great start in that last week, but Tuesday we had a 1.96% return, followed up with Wednesday a 2.02% return. On Thursday we had a 2.57% return, and on Friday we drew a close with a 1.02 or 1.03% return, all equating to the 7.4% realized growth, which was absolutely fantastic. Looking down here, portfolio metrics, the annual inflation rate. Got inflation on my mind constantly at the moment. The annual returns rate so far is 65.9%, which broken down over the months is 13.2% average. Broken down over the last 22 weeks of 2025, we have a 3% per week gain on average every single trading week of 2025. I mean, come on, that's really good. That's really going some. Bearing in mind as well, again, for those of you who are on the broader audience here, not the inside team yet, that is all with a maximum risk per position of 0.25%, done in real time every single day, live in front of our community members. Okay, it's a pretty damn good thing. It's really neat. Anyway, going down to trading volume, May saw. I'm not entirely sure what happened to April's data. It's just disappeared. May's data anyway, we had 29 longs, 29 shorts, so we're a complete 50-50 split between long versus short volume. So that's our current AUM and obviously returns. That's cumulative returns, including withdrawals. So that's 640.76% so far in the green, which is great. And there's our UTCF return versus the average weekly returns of the S&P and the UK FTSE for the US and UK stock markets. So pretty decent. So looking at the market trends and opportunities this week then, guys. So of course, it's not. I'm going to give you guys nuggets. So German 40 this week, we are looking at that immediate kind of sell-off back down to liquidity before we get the big rally back. We are very pro stock markets. We are very bullish stock markets. And we do believe this will continue. The trade war, volatility and stuff, we've got Trump doing some market manipulation around here. We know that's occurring. But it's ultimately long green and strong the stocks all the way. So we're looking for a temporary pause, bit of a pullback, a bit more profit taking place. We need to think about the commercial banks and funds, how they position themselves in the markets. They don't want to be unloading a shed load of cash at this stage right now. They want to be going back to a previous level of interest, so they're going to be headed back down. I'm thinking somewhere around the level here, indicated in the chart. You can see the supply and demand down here. I'm thinking that's going to be a pretty decent level to sort of, buy in commercially speaking. So we'll be looking at getting in just a little bit after them and then riding the big bull wave back up to that 2440 all-time high. If it doesn't and we break structure early, then we can position ourselves anyway. It makes a little difference, but that's ultimately where we're expecting to head to this week. On the flip side of that, we got our FX pick of the week, and that's in the Aussie NZD. Aussie NZD is looking superb at the moment, guys. It's looking really, really nice. Major point of inflection down at the 106.50 area. Had this big, nice commercial buyback. Very big change of hands going on down here at the moment. Big break of structure. Commercial candles almost the full way up the run here, right the way back to the previous point of inflection, and then it's come down again. So at the moment we're at a real key decision point. It's a break, close and retest for a short. You can see I've outlined it for you guys. Breakout, close underneath the level, retest of the level, continuation of the level. It's at that stage and around there of the move that you can consider taking a short. Now this one's probably going to last around 48 hours. It's really down to you how you break that down. You could have it split into 2 intraday positions, 1 4-hour trade one day, another 4-hour trade the other day, or you can just let the damn thing run. It really is your choice. The opposing view, of course, is a breaker structure long for that long buy and hold. You're going to be holding on to it maybe 48, 72 hours. It should be done this week, either or. Whichever trade you decide to take should be completed by the end of the week. We go down here looking at the weekly energy and metals. We've got natural gas this week. As I said, we actually killed it in the oil markets the previous couple of weeks. So I decided to take a step back from there before, handing gains back. So natural gas at the moment is looking really, really nice. We've come down to the commercial point down here. Great buyback opportunity. It's already kind of taken place at the moment, but I'm thinking of getting the second stage. So you've got the first stage bounce, you've got your second stage continuation. We are looking at that rallying back from maybe 330, 335 back up to 340, which would be really nice. 345 possibly back up to the highs there. So that's the natural gas view. And then we've got gold here as well. Now gold at the moment, not looking amazing actually, but I did feel the need to include it because it's so sensitive to US economic data, and we've got some really big stuff coming out this week, as you were told at the beginning of the session here. So looking at gold at the moment, pretty significant week in terms of US jobs data, employment data. We also got the jolts as well in the run up to the NFP, of course, which is going to throw a little bit of volatility into the mix. Ultimately, guys, we're looking at a medium break. So we've got the sort of, the established range sort of margins here. A little bit of a flag on the daily time frame has definitely formed here. I've indicated that by a light sort of sketch of the trend at the moment. But ultimately, guys, we're looking for a breakout of this level here. We get the break close and retest of that 335. We're looking long, green, and strong back up to 343, the previous highs, the all-time highs level, and that's looking great. But it is very sensitive to the fundamental data, so things have to play out in the right order in order to make the most out of it. Obviously, you can find out more inside the trading room, whatever, whenever you want. If we scroll down there, we've got market challenges. Now, the way the market challenges section of the report works, this is commercial data, okay? So I've got access to commercial data. I pay for various items that I use in my own trading setup and stuff like that. So ultimately, I'm just giving it to you. This is free. There is no, buy my shit and you get this sort of thing. This is all free. I personally pay for it. I put the data into the models. The models give it to you. The models are proprietary. So these models have been created by myself and by my team, and they give you price bias expectancies and impact against broad market view as well. So it's really, really good stuff, and we utilize this every single week in our trading. And so at the moment, we've got 3 registering as market challenges. The first one is the Euro annual inflation rate, which is coming out, which is only registering as a 3 out of 10. We've got the ECB interest rate decision, which is looking at a negative price bias in the euro. Now, if it's a negative price bias in the euro, what is it? It's a positive price bias in the United States dollar. And if it's a positive price bias in the United States dollar, it's a negative price bias in gold. So this is why we think about the cross correlation between assets in the market. Actually, scrap that. I'm probably going to lose you there. One does one thing, which does something to something else, and so therefore it could be a challenge to that particular asset that we're looking at. And so that's why we want to be thinking about what's going on this week. How can we avoid it? How can we position ourselves in a defensive stance where we're not going to lose much money if things go against us? That's what it's all about. It's about protecting your capital at all costs. So looking at the third and final one, we've got US non-farm payrolls. Again, negative price bias in the dollar this time, which is naturally positive in the euro, positive in gold. So that could be the bit of the sort of the counterweight, if you like, pushing gold back up. So it's going to be a bit of a turbulent week. But those are the 3 main economic catalysts, which are going to cause sort of market challenges to the particular assets that we're looking at trading throughout this week. Now, as we scroll down here, this is actual commercial data. Okay, so this is commercial longs versus shorts in the asset classes that we are focusing our attention on this week. So first of all, we got the DAX, which is 49.77% long, which means it's actually over 50% short. Don't be alarmed. This is well within the normal remit of that 50-50 long versus short liquidity that we see all the time. So you don't need to worry about this one. Out of all of these, I'm actually going to skip a few of them because I don't want to waste time. Ultimately, there's a couple of notable callouts. Aussie NZD and the VIX. The others are well within their normal remit, 51.37, fine, that's a normal 50-50 fund liquidity setup. Natural gas, 50.2, exactly, it's normal, your normal amount of longs versus shorts with your very, very minor fluctuations, which ultimately causes the slope up, or the slope down and the rise up. That's what you guys see on your end when you look at the charts. That's the kind of difference that we look at in a very nice gradual sort of upward push, 51 point whatever or 50.5 or something. Notable callouts, however, this week: VIX and Aussie NZD. Now, the VIX obviously measures volatility against the S&P 500, but it's actually got a big step down, 46.28%. So volatility probably going to be at a low unless obviously the White House administration comes out with some latest tariff that they're going to U-turn on again in like the next 15 minutes. So that's still there and it's still present. The geopolitical situation at the moment in the markets is heightened. So if you're a retail trader and you're just learning about the markets now, it's a pretty turbulent time for you to do so. I definitely think it's a great time to do so because why wouldn't you want to be thrown in the deep end and cut your teeth on something decent? But it's also going to come with a few risks. And we talk about defense, we talk about that kind of stuff a lot in our daily sessions that we provide inside the trading room, and it's very, very good, very, very good stuff. So you definitely hit that up if you want to. Remember, The general access is free to the community, guys, not paid. It is free. So you go to UTC Basic, go to utc.com, go on pricing plans. It will immediately show you the investor tier. If you actually go back to UTC Basic, it is free. There's one session done a week, every single Wednesday. We talk about defensive stance, we talk about risk management. We get you guys set up in an appropriate way to be able to handle the markets in a safe environment, so you're not going and following Mr. Millionaire, day trader, risking 300% of his account on, a bunch of bollocks, basically. So the next thing is the Aussie NZD. Okay, Aussie NZD is a notable call out because it's actually dropped down below the 2% variation at 47.93%, which means there is a serious over amount of shorts in the market at the moment in the Aussie NZD, which actually plays to our favor because one of our ideas here is the big short down to the previous lows. So we do definitely have some commercial money on our side if we're interested in going short the Aussie NZD. Now, on the third and final page of this report, we have the economic and order book impact. And this is the good stuff. Now, of course, everybody likes a trade idea. Everybody likes, the opportunity to make some money. Definitely, right? I get that. But this is where the actual important data is. This is the most important part of the whole report, without a shadow of a doubt. The economic impact scale is the proprietary model that I was discussing with you just a moment ago. Stay with me. This model takes all of the week's economic news. So let's say you're a relatively new trader, been in the markets for a while, but you might not be excessively experienced, and you open up your economic calendar so you can look at the news for the day ahead, and you see the news and it's got 50 different bloody releases on there. And some of the economic calendars are even really kind, aren't they? And they give you a little bull or a bear sign, and they have 1, 2, or 3 to show you the actual scale and the impact of the event. Now, look, guys, I don't beat it around the bush, all right? So it's a bunch of bollocks, right? You look at those things. I mean, I don't know where a lot of these guys got their jobs, but they certainly didn't have to do much to get their forecasting jobs, because 9 times out of 10, these events are taking place in the markets. You don't see anything. And if you do get the odd one that's a real mega impact event, that's going to be the one that's like a 1 star out of 3 in terms of impact. What my model does is it takes all of the major events and it thinks about, it's not AI, by the way, this is nothing to do with AI. This is a model that I personally have been working on and created for this. It takes all the economic data, it reads and understands all of the previous data points leading up to that particular one. It gives itself a measurement of either stability versus instability in the data, the likelihood of either or, and then it represents that in terms of actual broad economic impact to the markets. So US non-farm payrolls on Friday. Some of these US non-farm payrolls have not measured a 9 out of 10. There was one recently that measured a 6 out of 10, which, if you think about it, that's not actually huge for a non-farm payroll event. The impact it had was, I would have said, was probably a 5 or a 6 out of 10. It wasn't really a huge impact. We got a little bit of a move in the stock markets. The dollar index moved like nothing at all. It literally bumped it on the 15-minute time frame, didn't do anything. So this really does give you a good idea of, number one, what news events you should actually be listening to in the week as a new trader, even as an intermediate trader. If you're not into economics, why the hell do you want to be knowing about every single different economic indicator out there? All it is noise, and it is a distraction to you. Whereas this clears up all the noise. It takes care of all that for you, and it gives you a really clear-cut view of what news is important and how much will it impact my charts. How much is it going to give them a bump? So RBA minutes, for example, is registering as a 2 out of 10. The Euro inflation annual rate is registering as a 3 out of 10. JOLTS is a 4. The BOC rate decision is a 6. The ECB rate decision this week is actually a 7, which even I'm a bit surprised about. That's actually thinking it could be quite big. And the US non-farm payrolls this week is registering as a 9 out of 10. That's pretty big. So that's saying, for example, that on the Dow Jones or the NAS 100, probably going to see a couple hundred pip spikes. on the release of that US non-farm. So it'd be really interesting to catch up with you all on the following Monday to actually have a think about what that looked like in the charts and if it was right or whatever. So if we go down here, moving on, we've got the multi-asset impact gauge. Now this thinks about news and which individual asset class it's going to most highly impact. So for example, this week with all the news that we have, it's saying that the FX market has a 60% exposure to the economic data that's being released, whereas equities and indices are 15 split and commodities get 10% on the back. So the FX market is going to be most impacted by this week's news. Looking at money flow trends, this is total registered liquidity, right? From various sources of broker data, commercial and retail. So we look at this and we think to ourselves, at the moment, there's nothing that actually jumps out apart from indices, which is just on the cusp of overbought. Not overbought, I don't like using that term. I don't believe there is such a thing, and you can hold me to this. I say this all the time. I don't believe in such a thing as overbought or oversold, like an RSI indicator, for example. But I do think about where there is a large variation in liquidity. So if there's a 52.5% of all liquidity that is long in the indices, I'm going to be interested in buying some. I want to buy it. I want to be involved in that, because that means that there's probably going to be a greater chance of the markets having a rally than being sold off. That's what that essentially means. And then we go down here. We've got some equities as well. I love the equities markets. Really, really big into the stocks. I've got weekly suggestions here: SMCI, Dow, FSLR, and Tesla, with the spotlight of the week being Nvidia. Now, I'm not usually a AAA stock guy. I'm not a mainstream stock dude. I like real cheap. I like buying large volumes. Okay, so we're talking about, ultimately get my words out here. I like low cap stocks. I don't like large cap stocks. I'm actually not even that interested in mid caps. I'm all about buying at cheap values and buying large volumes of it. $3 to $5 a share. Jump in 1,000 shares. Jump in 2,000 shares. Ride in the wave for a day. Not even, sometimes way less than that. Some mad stuff. But that's the kind of thing. The reason I'm going on about Nvidia at the moment is because they are at the forefront of consumer and commercial, to a certain extent, artificial intelligent GPU manufacturing. Once we see those bad boys being rolled out on a mass scale, their price is going to go crazy. And we're already up at around that sort of, we've had a nice sell-off recently. We've been being bought back for the last maybe 2-3 weeks. We've got room to wiggle. We've got wiggle room up there because you're not at the all-time high yet, but you're getting there. And then we've got a lot of room to go above there. So that's just an idea. Now, of course, guys, that's basically it. As the disclaimer, the information provided in this market analysis report is, of course, informational and for educational purposes only. It should not be considered as financial advice or recommendation to trade or invest or anything like that. Trading in the financial markets involves a hell of a lot of risk, as you know, and it may not be suitable for all of you guys out there. Okay, so this is purely informational purposes and educational for you guys, just to have a real good dig into and just see what you think, really. So that's going to be it for the market report video this week, guys. I am going to make my best efforts to come out every single Monday and record just such a breakdown for you. Remember, you can go to the trading room, jump inside the trading room for free, and you can get that for free. I'm not trying to sell you anything. All of this, the ideas, all 3 pages of information, the inside stuff with the commercial liquidity stuff as well, my proprietary model for the market challenges and the economic impact scale. All of this stuff is developed to make life easier for you and to give you the best possible market insights around for our level of trading, before you get up to the big boys and you're using your BB terminals. So this is what our mission is here. So hope you really appreciate the video, of course. I've loved being here. Take care of yourselves. Good luck in your trading weeks. Trade safe, and I look forward to the next one. So I'll see you then, guys. Bye-bye.